Remember the global financial crisis in 2008? It was a stressful and brutal time period that shook financial markets and banking systems worldwide. Millions of people lost their jobs, homes, and life savings. We just experienced something eerily similar in crypto, with more than $500 billion worth of value evaporating into thin air, hitting retail investors the hardest.
Which really can't be understated, right? This event is probably the most destructive wealth event in the history of crypto.
The stablecoin UST, which was promised as a safe place to park your money, similar to a savings account, proved to be everything but. The Terra blockchain and its native token Luna lost 99% of its value in just a couple of days. From an all-time high of 116 per coin in April, the Luna token is now trading at less than a penny. The Terra ecosystem crashed as a result of a bank run, but this was not an accident. It turns out a savvy group of investors orchestrated it, netting close to $1 billion off of this George Soros-inspired trade. Who are these people? And how did they manage to bring down a token with a $50 billion market cap in just a few days? In this video, we'll break down the biggest collapse in crypto history. If you're even remotely interested in crypto, this is a must-watch. In this channel, we'll break down the fascinating world of Web3 and NFTs using knowledge from the fields of finance, economics, computer science, and psychology. Why? Because foundational knowledge is the key to learning, not pump and dump schemes. As a former Wall Street banker and startup founder, I've realized that the best way to learn about new trends and technology is to focus on the underlying fundamentals. We're in the middle of an internet revolution right now, and the world needs more domain experts. If you want to develop long-lasting Web3 knowledge, consider subscribing. As always, nothing on here is financial advice. Don't make financial decisions based on what a random Swedish guy says on YouTube. The blockchain protocol Terra was created by the South Korean startup Terraform Labs in January 2018. Led by CEO Do Kwon, a 30-year-old Stanford grad known for his charismatic and somewhat brash demeanor, Terra's vision is to facilitate the mass adoption of crypto by revolutionizing the technology of money. Realizing that previous innovations in the tech payment space were bootstrapped by large payment networks, PayPal with eBay, Alipay with Taobao, and Visa with banks, Do Kwon created Terra with the support of 15 large e-commerce companies in Asia. These e-com players collectively process $25 billion in transaction volume and serve more than 45 million users. Crypto is incredibly volatile, which holds back a large portion of potential users. Do Kwon and his team believed they could combat this and attract new users into the space by creating a new stablecoin, a cryptocurrency that is price stable against the world's major fiat currencies such as the US dollar. The idea was that Terra stablecoin UST would be worth exactly $1, regardless of what the overall crypto market sentiment was. Stablecoins have been around for a while, so this wasn't exactly a novel concept. The world's largest stablecoin Tether, or USDT, has been pegged to the US dollar since 2014 and currently sits at a $75 billion market cap, making it the world's third biggest crypto asset. USD Coin, or USDC, is another popular stablecoin that was launched by peer-to-peer technology company Circle with support from Coinbase. Everyone wants to become the reserve stablecoin of the multi-trillion-dollar crypto economy. Both USDT and USDC are backed by stable assets like dollars and bonds. For every $1 worth of stablecoin issued, $1 of actual US dollars is held in a reserve at a bank account. This is the safest way to do it, although whether Tether's reserves are actually fully backed have come into question lately, and Jim Cramer is one of many vocal critics.
But I am concerned about Tether, and I'm not going to stop shouting the alarm until I know what Tether has. They've got about 60 billion in commercial paper. Tether, open up the kimono. What commercial paper do you own? You're supposed to be owning something that looks like legal tender.
It's important that stablecoins are worth exactly $1. That's literally their sole purpose. Crypto is a risky asset class, and even the most popular cryptocurrencies, Bitcoin and Ether, can fluctuate widely in any given day. For that reason, crypto investors need a reliable and stable place to park their money. Stablecoins are supposed to serve that purpose. They are the crypto world's risk-free assets, a safe haven from all the crazy volatility. In contrast to USDT and USDC, Terra's stablecoin UST is not backed by US dollars. Instead, it's designed as an algorithmic stablecoin intended to maintain its peg through a model called burn and mint equilibrium. This is how it works. The blockchain Terra has two native tokens, Luna and UST. You can always redeem one token for the other, dollar for dollar. In April, Luna was trading at around $100. This means that if you had one token of Luna, you could redeem it for 100 UST by burning Luna token. This decreases the supply of Luna in circulation. Similarly, you could redeem 100 UST for one Luna token. An important thing to note here, even if the stablecoin UST is trading for less than $1, you can still redeem it for $1 worth of Luna. If UST falls to 99 cents, an arbitrageur can buy it and redeem it for $1 of Luna for a 1 cent profit. This is meant to be a stabilizing mechanism to ensure a 1-to-1 ratio always holds. In plain English, if you have a dollar bill and someone offers to pay you $1.01 for it, you would of course trade it since you'll make a 1 cent profit. Unlike traditional stablecoins such as Tether and USDC, Terra stablecoin UST is not backed by external collateral such as US dollars. Instead, UST is backed by its native currency Luna and more recently by Bitcoin. UST's success is therefore highly dependent on the market demand for Luna and Bitcoin and their respective price volatility. If Luna and Bitcoin were to suddenly depreciate in value, it could cause a death spiral. Everyone would want to cash out at the same time and lead to a run on the bank, similar to what we saw during the 2008 global financial crisis. Sadly, this is exactly what happened. Ryan Clements, a faculty member at the University of Calgary, wrote a paper in November titled Built to Fail: The Fragility of Algorithmic Stablecoins. In his paper, Ryan argued that algorithmic stablecoins are fundamentally flawed because they rely on three factors which history has shown us to be impossible to control. Number one, algorithmic stablecoins require a support level of demand for operational stability. In Terra's case, there needs to be a constant demand for their native tokens Luna and UST. Terra tried to incentivize holders by offering 19 to 20% annual staking yields through its Anchor protocol. 2. Algorithmic stablecoins rely on independent actors with market incentives to perform price-stabilizing arbitrage. As we discussed earlier, Terra relied on arbitrageurs to make sure a 1-to-1 ratio always held. 3. Algorithmic stablecoins require reliable price information at all times. This is probably less of an issue in today's day and age. We have access to live market data at our fingertips. If one of these three factors begins to crack, the whole system could fall apart. And Ryan Clements wasn't the only one who saw the inherent risks involved in Terra's ecosystem. An investment firm decided to make a massive trade out of this. A trade that would net them $1 billion in pure profit, and sadly at the expense of retail investors. Before we discuss exactly how this group of investors brought down Terra's $15 billion ecosystem, let's travel back in time and explore one of history's greatest and most controversial trades. This is George Soros, one of the world's most prominent and wealthiest hedge fund managers. In 1992, he pulled off a trade that literally broke the Bank of England, netting him $1 billion in a single day. How did he do it? By shorting the British pound and instigating a panic sell-off. Leading up to 1992, the British pound was fixed to the German currency Deutsche Mark at a rate of 2.7 marks per pound. These types of fixed exchange rates were part of the exchange rate mechanism, or ERM, a system introduced across Europe as a result of the Second World War in order to build stronger economical ties between nations. ERM would eventually lead to the introduction of the euro currency in 1999. Despite this fixed exchange ratio in 1992, Britain and Germany were very different economically. Britain's economy was strained by the global recession and unemployment was high. The overall market believed that the British Central Bank, the Bank of England, would be able to keep the British pound fixed to the Deutsche Mark at the predetermined 2.7 ratio. Why wouldn't they? It's the British Central Bank after all. Sitting in his Manhattan office, George Soros believed the opposite. He figured that Britain's poor economy would lead to a devaluation of the British pound, which would break its peg to the Deutsche Mark. So Soros decided to open a short position on the pound. By September 92, Soros had borrowed close to $10 billion worth of British pounds and sold them to buy Deutsche Marks instead. The idea being that when the British pound would drop in value as a result of a panic sell-off, he could buy the pound back and then return it to the lender, pocketing the difference. Once Soros started to sell $10 billion worth of pounds overnight, it caused a cascade effect which led other investors to sell their pounds as well. In effect, Soros single-handedly catalyzed a broad sell-off of the British pound. This day, September 16, 1992 became known as Black Wednesday and almost broke the Bank of England. So why is any of this relevant to crypto and Terra? You see, the investors or attackers that brought down Terra Luna used a very Soros-inspired approach. Realizing the flaws in Terra's ecosystem that we outlined earlier, the attackers accumulated $1 billion worth of UST and borrowed $3 billion worth of Bitcoin. Why did they do this? Well, remember that Terra used Bitcoin to back its stablecoin UST. Having borrowed Bitcoin, the group began to sell all of it at the market and spread fear about a potential depeg and bank run. $3 billion worth of Bitcoin is of course a lot, so it will naturally impact overall market and trigger a wider panic. The group then began to sell its $1 billion UST position. This downward pressure on UST created a small depeg. Instead of 1 UST being worth $1 US, which is supposed to, it's now worth 98 cents instead. However, remember that as part of Terra's stabilizing mechanism, arbitrageurs can still redeem 1 UST for $1 worth of Luna, regardless of how much 1 UST is actually worth, in this case 98 cents. So UST holders begin redeeming UST for Luna. This causes the price of Luna to dump. As a result, UST holders become less confident that their stablecoin will actually hold any value at all. So they sell UST, which causes Luna to dump even more. And so the cycle repeats itself in a death spiral. In an attempt to restore the peg, LFG, the Luna Foundation guard, starts to sell Bitcoin. But this is exactly what the attackers want, since they've shorted Bitcoin. The more Bitcoin tanks, the more people panic and the more UST is sold, causing more depegging. This leads to mass panic, a stampede, and a bank run on Anchor. Everyone tries to exit UST and Luna at the same time. This George Soros type of a move from the investment firm netted them close to $1 billion in profit. So who are these investors? We don't know for sure, but they're obviously incredibly savvy with deep pockets. Pulling off something like this is no small feat. It could only have been possible by someone with market-making influence. Some people think it could be the hedge fund Citadel, but Citadel has denied the allegations, saying they don't trade stablecoins. The collapse of UST was so significant that it caught the attention of Treasury Secretary Janet Yellen.
The risks we see in connection with one form of crypto assets, which is stable coins, and there we see run risks which could threaten financial stability.
As of recording, the Terra blockchain has been halted and the Luna token has lost 99% of its value. That's $50 billion worth of people's hard-earned money and savings gone into thin air. It's very sad, and my heart goes out to all those affected. This is no small loss, and I understand that there have been reports of suicides. While this wasn't illegal, it baffles me that one would go after people's savings. UST was supposed to be a safe place to store one's capital. On the other hand, if you're being paid 20% APR, it surely comes with risks. Crypto markets are incredibly risky, and it's important to be careful out there. Only allocate capital to this industry if you're willing to lose it all. Crypto is still a nascent technology, and it'll take time for the industry to develop and mature. Despite all these swings, crypto is here to stay. Amazon lost 95% of its value during the dot-com bubble in 2000, and Apple lost 80%. Whether it's an entire blockchain that goes down or an attack on an NFT game, it's important to stay informed. The Web3 space moves fast. The game Axie Infinity recently experienced a hack that cost players more than $600 million. Watch this video next to learn what happened and what events like these mean for the crypto space. Thanks for watching.